right, YouTube, here comes part two as promised. They're going to answer some questions regarding the vacancies in the leadership and some of their outlook for next year. If you enjoy this video, go ahead, like, and subscribe. You can get all of these videos on the Rolls-Royce website if you want to find them yourself.
Hi guys, thanks for taking my questions. A couple really for me. Firstly, on the engine flying hours, indicated at 70% down in Q4 roughly. You mentioned, Warren, within your prepared remarks about utilisation of the XWB. Can you give an indication of what's going on in terms of utilisation for the other models? So particularly the Trent 700 I'm interested in, and Trent 100. Trent 1000. This first question.
Yeah. So I think Trent 700. The older you get, the less utilised you are. That's the basic rule of thumb, and it's really quite difficult to generalise much more than that. Very, very approximately, Trent 700 is about half the utilisation rate of XWB at the moment. XWB and Trent 1000, the A350 and the 787, these are the aircraft that are getting used most in the wide-body space at the moment. And then when you get into A330s, used less. When you get into the older aircraft, then it's used even less, and that's rule of thumb. But we've got a bunch of different airline customers that all have different approaches. Very approximately, utilization of aircraft, whether an aircraft is being flown or not, is just one measure. And how much it is being flown is another measure. So XWB and Trent 1000, they're getting used a lot. So XWB 97K is back to the levels that it was in 2019. But that is a very small part of our fleet. When you get into higher, bigger volumes and so on, then they used a bit less. And then during an individual day, whether an aircraft is used, maybe it used to be used 2 or 3 times a day, and now it's being used once a day. On average, XWB's about 12 hours a day at the moment for those that are getting used, which is significantly less than it would normally be used.
Sure. Okay. Thank you very much. And then the second question is around free cash flow and various guidance you've given for 21 and 22. So can you confirm what you're guiding is premised broadly around the base case scenario of a recovery to 70% in 21 and 90% in 22? And what gives you confidence that this is still realistic given the trends we're seeing today? Is it merely availability of vaccines is just going to free up everything in that time frame? Is that what you're assuming, or any comments around that helpful?
Yeah, so I think we're going to give a bit more specifics about this when we do our full year results. I mean, there's a huge amount of uncertainty around what's going to happen in 2021. And there's less uncertainty, obviously, about what's going to happen in 2022, because we do see a picture of, vaccines helping, vaccines being a significant factor. But, it's all about government-to-government relationships and opening up of air corridors and routes. That is, we see a 2021, second half 2021 phenomenon. And that's why we can be a bit more certain about 2022 than we can be about 2021, which is giving us confidence. Well, that's giving us some confidence in underpinning our £750 million target for 2022. What's giving us most confidence, however, is, as I said in the remarks a moment or two ago, the things that we can control. We know we are removing fixed cost from out of our business and improving the operational leverage. And that's the primary factor. Engine flying hours are going to, and the rate at which engine flying hours come back is going to affect timing, and that's why we're a bit more uncertain about 2021. We remain confident we can get into positive cash generation territory in the second half of 2021, but whether that's at the beginning or the end of the second half, that depends a bit on engine flying hours and how they perform. And don't forget, we do have the other half of our business, which isn't civil aerospace large engines. Business aviation holding up very well, defence holding up very well, power systems responding a bit like civil aerospace, but much less so, and it's a shorter cycle business. And if we look, for instance, at the rate of recovery in power systems in China, we saw that come back quite swiftly. So just remind people that there's another half to our business as well.
Understood. Thank you very much.
And the next question comes from the line of Ben Heelan from Bank of America. Please go ahead.
Hi, good morning. Thank you for taking my question. One, I guess, just back on what Andrew was asking there. I guess another way to ask it was, you said that the recovery to positive free cash flow is going to be dependent on that recovery in engine flying hours. Is there a way to gauge what level of engine flying hours need to be back relative to 2019 in a given month for you to be free cash flow positive? Is there a way to frame it around that? That would be the first question. And then the second question, could you talk a little bit, has there been interest in ITP and Bergen, and are there any other facilities that you're considering putting into ITP to make it more attractive to a bidder? Thank you.
Thanks. I'll take that those two questions, Ben. So yeah, we're not going to go into specifics at this stage around the shape of flying hour recovery in 21 and moving to cash positive. We'll share more of that with our full year results in March. I think what I would say though is that we've been tracking our cash flows very carefully over the last 9 months. We've seen a good trajectory, and we've got good confidence around that ability to turn cash positive at some time during the second half of next year. On ITP, we are already engaging with the potential buyer universe on this. There are several interested parties, and we expect that there'll be a pickup in activity in the first half of next year as we really get into the sale process and we go through the management presentations and all that usual sort of malarkey that goes on with a disposal process. And we'll keep you updated on the progress as we go along.
Okay, great. Thank you.
And the next question comes from the line of Nick Cunningham from Agency Partners. Please go ahead.
Good morning. Yes, a couple of perhaps slightly longer term questions. Obviously, there's been a lot of learning in the last year or so for everybody. And I was wondering what the experience has said to you about what a prudent capital structure is to aim for at the end of all of this process. Does Rolls-Royce sort of have to be net cash, if you like? And would that be before or after the lease liabilities, to be more precise? And then the second question, the 1.3 billion of cost reductions, to what extent are those just aligned with the anticipated lower revenue base, or is some of it going to result in a lower unit cost? And if so, if there's any indications as to what proportion we might see contributing to a lower cost base going forward?
In terms of our view on ideal balance sheet, that hasn't really changed. We're looking for a net cash positive of circa £2 billion in the medium term. I think we had that view coming into this crisis, and we were on a good trajectory to get there during 2020. Actually, we were confident of getting there in 2020, having come into the year at 1.3 to 1.4 net positive. And I think that's still a sensible goal. It's driven by requirement to keep R&D going and that sort of thing. Terribly sorry, the second half of the question has completely slipped my mind.
Sorry, it's the cost reduction. To what extent is that?
Yeah. No, I mean, of course, this cost coming out through load coming out, but no, the 1.3 billion is structural.
So in other words, that would entirely stick if revenue came back up to 2019 levels.
Yeah,
you have a 1.3 billion lower cost base.
Yeah. I mean, you only have to talk to some of the unfortunate people who are losing their jobs, and it's sticking as far as our cost reduction is concerned.
Thank you.
And the next question comes from the line of Tim Schulte-Melander from Redburn. Please go ahead.
Hi there. Thanks for taking my question. Standing in for Jeremy Bragg. A two-part question, if I can. Just thinking about the Trent 1000 and aircraft on ground being a sort of unexpected beneficiary of this COVID crisis. First part of the question is, could you tell us what will happen to the Trent 1000 provisioning flows in 21 and 22? And then just again on those Trent 1000 sort of expected cash flows in 2021. What are you expecting now compared to what you would have expected, let's say, a year ago? Thank you.
Yeah. So I think with our half-year results, we talked about a reversal of provision on Trent 1000, and that was based on the fact that disruption that we had previously anticipated to be continuing to accumulate during 2020. We're now not seeing. And because of the ability to generate spare engines, we're now not anticipating, even if they all started flying tomorrow, we wouldn't anticipate accumulating any more disruption costs. And that's why we were able to reverse that provision. And then in terms of the impact on cash flow in 2021 and 2022, then we're still anticipating the already accumulated disruption costs in things like credit notes being utilised as before. I mean, no, any rephasing of that?
Yeah, no changing previous guidance on that one. And as a reminder, 21 and 22 will be the last 2 years of any material cash outflow on the Trent 1000. So 23 will be unencumbered by those cash flows. And that 750 million number that we guide to as well for 22 includes the final year of Trent 1000 cash costs of around £250 million in that year.
Great, very clear. If I could just sneak in one follow-up, and that's Stephen, on your replacements. Warren, could you maybe give us an update on where the company stands on the CFO search? Thank you.
Yeah, well, it's still ongoing, but we expect to be able to. We will have an announcement in due course, and obviously you can't announce these things until everything's signed and sealed. We want to choose the right person to replace Stephen, and I'm sure by the time we get to our full year results, we'll probably have some news.
Thanks very much.
The next question comes from the line of Sean Stewart from JP Morgan. Please go ahead.
Hi, good morning, Warren. Good morning, Stephen. I just have one quick question, please. You've reiterated your guidance this morning for at least 750 million in free cash flow in 2022 pre the disposal. Are you able to give us any EBITA guidance behind that free cash flow guidance, please? Thanks a lot.
No, we're not, actually. We may say something with our full year results next year, but no. And I would just flag just a wording point here, just to be specific. We've said 750 as early as 2022, so just to qualify that somewhat. But as it stands today, that's very much in our plans. But no, we're not giving any EBITDA guidance at this stage.
Okay, thanks a lot.
The next question comes from the line of Harry Leach from Stifel. Please go ahead.
Hello, morning, Warren, morning, Stephen, morning, Isabel. Thanks for taking my question. Just a couple if I can. Can you give us any sense about how time and materials revenues are trending? Have we gone through the bottom there specifically, or are we still seeing sort of deteriorating trends? And then slightly different note, just thinking about receivables collection rates, can you give us a feeling about how those are going? And Stephen, this is probably pushing it far too far, but in terms of payments, deferrals and delays you're granting to customers, can you give us any sense about whether those are sort of reducing now, sort of schedules are holding, customers aren't asking for payment deferrals? And any sense would be really helpful. Thank you.
Yeah, I'll do the second question first. As you might expect, we're seeing a number of dynamics right now. We're seeing airlines saying that they are just not able to pay minimum flying hour contractual terms right now, and we understand that. Now we are building up a debtors balance that you'll see at the year end, therefore of overdue debts. What we're also seeing, and that we expect to see in 21, is increasing credit note utilisation as well. So we're seeing airlines using credit notes to avoid cash outflow. Again, no surprise there. I'm not going to go into details of numbers at this stage, but these dynamics are certainly out there. Beyond that, we at the same time though we have many customers who are paying cash for their minimum flying hour terms as well, and they're in the majority. So it's just worth highlighting that side of it as well. And so I think those are probably all I would say at this stage on the cash flow dynamics around our customers this year.
Yeah, and on the long-term service agreement versus time and materials, then it's broadly similar. And just a couple of comments. In the long run, of course, time and materials is more prevalent on the older programs than it is on the newer programs, and so you would expect to see in the long run time and materials declining slightly as a proportion. But it's never going to disappear because, as we've said before, part of our long-term service agreement includes an element of time and materials for parts that mutually we agree with airlines and not covered by those long-term service agreements. So broadly similar is the picture at the moment.
And if I can just to clarify my understanding, Stephen, sorry, but where you take a credit note from a customer, is there any security you have for payment of that credit note?
No, these are customer credit notes that they have that they can use against our flying hours.
So, for instance, when we agreed a compensation payment for disruption on Trent 1000, instead of actually paying over pound notes to an airline, we gave them a credit note that they could then cash in at some stage in the future. And each contract's a bit different. Sometimes we talk about proportions of those that you're allowed to use and so on, and it's all individual commercial negotiations. But there is a general picture of credit note utilisation in this period as airlines are strapped for cash. Yeah. And that's going to continue in 21 and 22.
They each have their own timing terms, but also degree of magnitude terms as well.
Okay. Thank you very much.
And we have one more question from the line of Andrew Humphrey from Morgan Stanley. Please go ahead.
Hi. Thanks very much. I know we're not talking in too much detail about 2021, but I wanted to make sure we understand some specific components of it if we're trying to kind of build models that bridge from 2020 on cash flow. You've obviously been quite clear about the non-recurrence of the invoice discounting effect. I think we can probably do our own arithmetic on the flying hour impact based on an assumed level and the sensitivity that you've given around that. But I wanted to ask about other specific effects on free cash in 2021, specifically the first half of 2021 versus 2020 that you can quantify versus, so for instance, the benefit of restructuring or any other components that you'd care to highlight versus this year as we're building bridges.
I'll highlight two or three. First of all, the savings from the restructuring. The full savings, full run rate savings to be delivered by 2022 is £1.3 billion. Now, that will more than replace the £1 billion of cash mitigation actions that we've taken in 2020. That's a key component. Another important component is capital expenditure. I won't go into specific numbers at this stage, but we are expecting a further downwards revision of capital expenditure in 21 versus the 2020 number. So that's important as well. I think a third area I'd point to is our operating costs generally, and the work that we've done there during 2020 to really identify those non-essential items of spend where we can operate with a lower cost base. And I think we've probably all experienced that during COVID-19, caused us to have a new lens of a way of working generally, and that has, we see opportunity in our operating costs as well. So those are the three key areas sort of outside of those assumptions that you just highlighted.
Okay, thanks.
And we have one more question from the line of Andrew Gowan from Berenberg. Please go ahead.
Yeah, hi, thanks. One more from me, please. Working capital question and cash again, I suppose. So can you give some idea of the quantum of risk around the customer concessions issue, or maybe answer it this way? You know, what is the scale of payables that built up on delayed Boeing 787 deliveries?
I'm not going to go into specifics around it. They can be material. You've seen that in recent years, but I won't go beyond that. And it's very much down to, as we've said in our trading update, the timing of aircraft deliveries, whether it's before the year end or after the year end. But beyond that, I wouldn't really want to add any more.
Yeah.
Okay. So to be clear, it's the risk is over and above the 4.2 billion guide.
Yes, that's correct. Yeah.
Yeah. Okay. Thank you.
I think that's it as far as questions are concerned. So let me just sort of summarise the messages we want you to take away. We're concentrating on controlling the things that we can control. We're very pleased with our progress on that, particularly around the restructuring and the operating costs, as Stephen just discussed. And that means there's essentially no change to our forward-looking guidance. We remain confident of achieving positive cash flow, going through that break-even point in the second half of 2021 and generating £750 million of free cash flow as early as 2022. And with that, we'll thank you very much, and we'll be back to report on the full year properly in the first quarter.
This now concludes our conference call. Thank you all for attending. You may now disconnect your lines.
All right, guys, if you made it this far, that's all I've got for today. I hope you all have a great week, and I hope you learned some things from this video. They answered some important questions. Hopefully that helps you make some informed decisions next week or in the future. Anyways, guys, have a good night and a good week trading. Stock Surfer signing out.